When you hear the word bond, what probably comes to mind is James Bond, tuxedos, gadgets, fast cars and martinis. But in the financial world, bonds are even cooler. They power a global market worth over $140 trillion, bigger than the entire stock market. And they are the backbone of governments, corporations, and financial markets worldwide. In this video, we're going to break down everything you need to know about bonds, what they are, how they work, and why they matter. So what exactly is a bond? At its core, a bond is really just a loan. Imagine lending money to a friend. You give them some cash today, and they promise to pay you back next month with a little thank you bonus. That's exactly what a bond is, except on a much larger scale. When you buy a bond, you're lending money to a government, a company, or even a city. In return, they promise to pay back the amount you lent, called the principal, on a specific date, along with periodic interest payments, known as the coupon. Bonds let organizations raise money without going through a single bank. Instead of borrowing from one place, they borrow from thousands of investors at once. This allows them to access huge sums of money efficiently, often at lower cost and with more flexibility. Now you might be thinking, wait a second, isn't a bond just a loan? Why do we even have a separate name for it? The difference really comes down to scale and structure. A loan usually comes from a single lender, like a bank, and is a private agreement between the borrower and the lender. A bond, on the other hand, is borrowed from many investors at once and is a standardized security that can be bought and sold on financial markets. In other words, bonds turn borrowing into a scalable, tradable investment, while loans stay one-on-one agreements. Although bonds might look simple on paper, they have several moving parts that make them fascinating, especially in a market worth trillions of dollars. When you buy a bond, think of yourself as the bank, loaning money alongside thousands of other investors. To really understand bonds, it helps to know a few key terms. The first is the issuer. The issuer is the borrower, and it could be a national government, a local municipality, or a private company. When you buy their bond, you're giving them the money they need to fund projects, cover expenses, or grow their business. Next is the face value, sometimes called par value. This is the amount you agree to lend, and for most bonds, it's set at $1,000 per bond. When the bond reaches its maturity, this is the amount you get back. Then there's the coupon rate. This is the interest the issuer promises to pay you. For example, if a bond has a 5% annual coupon rate and a face value of $1,000, you'll receive $50 in interest every year until the bond matures. The maturity date is another key term. This is when the issuer pays back the original loan. So if you hold a 5-year bond, you'll collect interest payments along the way, and at the end of those 5 years, you'll get your initial $1,000 back. Finally, there's the issue price, which is the price you pay when the bond is first sold. Essentially, this is the cost of the bond when you buy it. Let's make this more concrete with an example. Imagine Noah wants to lend money to the government, but instead of handing cash directly to a politician, which obviously isn't how it works, he does it by buying something called a government bond. Here's how that plays out. The government needs money to fund big projects. Maybe they're building new highways, upgrading schools, or investing in renewable energy. Rather than raising taxes immediately or going to a bank for a massive loan, they decide to borrow money from the public. So they issue bonds, essentially IOUs, that anyone can buy. Noah sees one of these bonds listed for $1,000 with a 5% annual coupon rate and a 10-year maturity. That means if Noah buys this bond, he's lending the government $1,000 today. In exchange, the government promises to pay him $50 in interest every year. That's 5% of $1,000 for the next 10 years. Then when the bond matures, Noah gets back the original $1,000 he invested. So if Noah holds the bond until maturity, he will receive $50 each year for 10 years, which adds up to $500 in total interest payments, plus the original $1,000 principal at the end. That means Noah will have turned his $1,000 investment into $1,500 over 10 years. Now here's where it gets interesting. Noah doesn't have to hold the bond for the full 10 years if he doesn't want to. Bonds are tradable on the open market, so he could sell it to another investor after, say, 3 years. The price he sells it for will depend on market conditions, especially interest rates. If new bonds are being issued at only 3%, Noah's 5% bond suddenly looks very attractive, and investors might be willing to pay more than $1,000 for it. On the flip side, if new bonds are paying 7%, his bond becomes less appealing, and he might have to sell it for less than $1,000. Here's the thing, bonds come in many shapes and sizes, and knowing the main types helps you understand how they work and which ones might be right for you. First, we have government bonds, which are usually considered the safest. These are issued by national governments to raise money for things like roads, schools, or healthcare. Because they're backed by the government, there's a very low chance of them not paying you back. The trade-off is that they usually pay lower interest, but in return, you get reliability and peace of mind. Next are corporate bonds, which are issued by companies that want to raise money to grow their business, build new projects, or even pay off older debt. Since companies don't have the same financial power as governments, these bonds are a bit riskier, but they usually pay higher interest rates to make up for that risk. Then we have municipal bonds, often called munis, which are issued by cities or local governments. They're used to fund public projects like schools, roads, or hospitals. A big bonus with these is that the interest you earn is often tax-free, which can make them attractive for investors who want to keep more of their returns. And finally, there are zero coupon bonds. These are a little different because they don't pay interest every year. Instead, you buy them at a discount and receive the full value when they mature. For example, you might pay $700 now and get $1,000 back in 10 years. These are useful if you want a guaranteed payout at a specific time in the future. One of the most important things to understand about bonds is how interest rates affect their prices. And the easiest way to remember it is this: they move in opposite directions. Here's what that means. Imagine you buy a bond that pays 5% interest. If interest rates in the economy suddenly rise to 7%, new bonds will pay more, so your 5% bond doesn't look as attractive anymore. As a result, if you want to sell it before it matures, you'll likely have to sell it for less than you paid. But the reverse is also true. If interest rates drop to 3%, your 5% bond now looks great compared to the new ones, and other investors might be willing to pay more for it. This constant push and pull between interest rates and bond prices is a key part of how the bond market works. Even though you'll still get your full principal back if you hold the bond to maturity, its price can go up or down in the meantime, and that's something every investor needs to understand. Now let's talk about something called yield to maturity, or YTM. It sounds complicated, but it's really just a way of measuring how much money you'll make from a bond if you hold it until it matures. Yield to maturity takes into account everything: the interest payments you'll receive each year, plus any profit or loss you'll make if you bought the bond for more or less than its face value. For example, let's say you buy a bond for $900 that will pay you $1,000 in 10 years, plus $50 in interest every year. YTM calculates your total return from all those payments combined. It's like the bond's true return, and investors often use it to compare bonds with different prices, interest rates and maturities. In simple terms, the higher the YTM, the better the return, and that helps you figure out which bonds are worth your money. Bonds are often seen as safer than stocks, but that doesn't mean they're risk-free. Just like any investment, they come with a few things you need to watch out for. The first is interest rate risk. Remember how bond prices move opposite to interest rates. If rates go up after you buy a bond, the value of your bond might drop, especially if you want to sell it before it matures. Next is credit risk, also known as default risk. This is the chance that the issuer, the company or government you lent money to, might not be able to pay you back. Government bonds are usually very safe, but some companies or smaller municipalities might struggle, which means there's always a small risk you won't get your full money back. Then there's inflation risk. If prices in the economy rise faster than the interest your bond pays, your money loses buying power over time. Even though you're still earning interest, what that money can actually buy might shrink. Finally, there's liquidity risk. Some bonds can be hard to sell quickly without lowering the price, especially if they're not traded often. The key is understanding these risks before you invest. Bonds can be a powerful and steady part of your portfolio, but knowing the potential downsides helps you make smarter decisions and avoid surprises. So how do you actually invest in bonds? The good news is it's easier than it sounds. One of the simplest ways is through bond funds, like ETFs or mutual funds. These let you invest in a mix of different bonds all at once, giving you instant diversification without needing a lot of money to start. If you prefer more control, you can buy individual bonds through a broker and choose exactly which ones you want. Maybe that's a 10-year government bond, a corporate bond from a company you believe in, or a municipal bond from your city. You'll know how much interest you'll earn, when you'll get paid, and when your money comes back. And if you want the safest route possible, you can even buy government bonds directly from the source, like the US Treasury or your country's equivalent. At the end of the day, bonds are one of the most powerful yet misunderstood tools in finance. They might not be as flashy as stocks, but they're the backbone of the global financial system, helping governments build infrastructure, companies grow, and investors like you earn steady, predictable returns. Whether you're looking for stability, income, or diversification in your portfolio, understanding bonds is a key step toward becoming a smarter investor. And now, you have the foundation to do exactly that. We hope you enjoyed the video. Please like, comment, and subscribe for more.